Good. What is going on, everybody, and welcome to another weekly update. And in this video, what I like to do is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. If that sounds like something you are interested in, consider subscribing because I do produce weekly videos to get you prepared for the week ahead. I also will be doing some other additional videos here shortly to expose and talk about current events as well. But ultimately, what I like to do is to mix a lot of current events. I don't like to look too far ahead, probably like 6 months, but maybe even sooner than that. And then also use charts because charts tell you where the next target could potentially lie. So, with that being said, again, consider subscribing, drop a like, and let's get this thing rolling. So, the past week, we've had a lot of information come out essentially. And as we always do, we like to throw this up here to kind of give us insight because we like to go over the previous week and see what is currently going on and digest what's currently going on and kind of depict what the next event is. And if you're in the markets long enough, technicals do help to an extent. Knowing your macroeconomics helps for kind of like a long-term sentiment. But ultimately, I think that good fine zone is in between it all and mixing a good mix between the two and having a more short-term approach to what's going on with the next like 3 months and take it from there and understand the market is very dynamic and it can change very quickly. So you also have to be mindful of that. That's why you have to be current on events. Being said, last week was a very interesting week. Like I said, the market was essentially waiting for Jackson Hole. It was waiting for NVIDIA earnings, and we had both of those this past week. What were the biggest takeaways from that? Up to this point, we still have to realize we're still in the middle of a banking crisis. We have to realize that a lot of earnings are suffering heavily losses. But one thing that is shining bright when you are looking um, at the current market, and the world is changing right now, and something I've stated to this point is I believe we are in a global depression at this point. They will not announce a recession of any sorts until after the fact, and we start getting in a more of a recovery type mode. You have to understand that, by the time they announce that, we'll be in recovery mode and coming out of it. So you again have to understand that they're not trying to drive panic, because if they just tell people you're in a recession, then people are going to draw panic. You can't control people that are in a panic state. So to be able to do that, they try to pencil whip a lot of data, which people go off of data. You can't go off data. As they've revised a lot of numbers. Even over this past week, they revised, I think, over 300 some thousand jobs, which was absolutely absurd. Something we've been talking about. You need to be paying attention to that. This isn't going to move the market. What moves the market is the algorithms in the headline news that is essentially pushed out. And so when it's pushed out, the stock markets will move off of that, and ultimately understand the revisions don't matter, but they will matter in the future. So this is why I've been talking about all these black swan events, because it's adding up and eventually it will snap. We don't know what that event will be, but there will be an event that will cause this thing to start coming down. And so to be careful and be mindful in risk management, you need to either have a long-term strategy, or you need to be hedging your positions if you are just an investor, or you need to be managing your size depending if you are a swing trader or intraday trader. It really just depends on the current market, and you have to be up to date on these things. And so that's what I like to teach around here and kind of help with. So, but that being said, this past week we had Rite Aid preparing to file Chapter 11 bankruptcy. So you're getting a lot of big names filing for bankruptcy. And this is what is the concern is as of right now. There's a lot more already bankruptcies filed than there was back in 2008. You have to understand that we are referencing a lot of 2008 with the rapid rate and increase. The rapid increase in rates is going to cause very, very historical moves. And we've seen that almost all the moves and all the things that we've done to this point since the pandemic have been historic, because you've injected for an additional 40% of the money supply. So it makes things even 10 times worse than what it was. So that being said, we are still dealing with a lot of constraints with essentially interest rates. And I'll get into Jackson Hole in a second. But one thing I do want to pick out here is that Zillow is now Zillow isn't a mortgage broker, but they have banks that back them in giving loans. And they are introducing a 1% mortgage loan. 1%. And then I think they'll back you by like 2 or 3% on top of that if you put 1% down. This is how bad the banks need money. They are dropping standards to 1% because they still need a lot of these brokerages. They still need money to be flowing. They need that cash flow. If they can't get it, that's going to be a huge problem. And it's going to essentially collapse everything if it does not. And so this is something I want to touch on too, because a lot of people are, well, the stock or well, the essentially the housing industry isn't folding. It's not collapsing like everybody's predicting. We're almost hitting all-time highs with housing prices again. You have to understand the supply is so depleted that you sell a couple houses, your average is going to be extremely high. Of course that is. If you just put some common sense to a lot of these things, of course it would be, because of the fact that the supply is so dwindled because people don't want to move because it's right now unaffordable. But to live out of your house, it's a 3% fixed rate for 30 years. Why would you drop that to go into over 7% interest rate for a new home? Plus all the additional taxes and HOA fees and all the other things that are much more expensive, you still absorb some of those taxes and stuff like that through your current house, but at least your payment isn't ballooned to a 7% payment on interest rates. So on the back end, you're not paying as much. But it's not only that, if people fixate on the monthly expense of their mortgage loan and understand that that's even ballooned, I think it's up to 2,700 is the average as of right now. And a lot of people just cannot afford that. That is just absolutely absurd to think the average American can't afford that. So what they're trying to do is they're trying to kick it out to a 40 or potentially even a 60-year mortgage at this point. I think there was even some rufflings about a 90-year mortgage. I believe they do have that in Canada. So because Canada is just absolutely absurd on the whole housing market over there, and the ridiculous amounts of money that people are having to pay for homes. And we're headed down that way in the US. And so this is why we need normalization to bring down these prices and understand why the prices are still going up, because the supply is so low. So for that to actually reset, you need what the Fed are looking for is they need a harder reset. They need more people to be laid off, so they're forced to have to sell, is what Powell is trying to do. So you have to understand this is why we keep increasing rates, because we need that demand to be killed. And to be honest, I don't know where that demand is coming from. Maybe there's people going out there taking these 1% loans, but nonetheless, it's still being achieved. They're trying to make it a lot easier. They're even bringing back, I think they're called balloon mortgages, which is essentially you don't have to make a payment for 5 years, but you have to pay the whole thing after 5 years. Right. And so these are the new things they're starting to bring back, which is actually a horrible idea because you can't afford it in 5 years. It's going to, and something I talked about, it's going to be a lagging effect on how bad these interest rates are on the economy over the next several years. Even if the stock market recovers, that it's still going to have a big impact on the market in general. So all that being said, that 1% mortgage loans is a very terrible idea, but something that is being introduced. There's a lot of incentives to buy new developments. You have to understand where that is currently sitting, is that they are trying to get money out of people whichever way they can, and wrapping whatever kind of package they can to put you in a really, really, really bad situation. Like, you do not want to be buying now if you can hold out and survive. Also understand rent is way cheaper than trying to own a mortgage right now. And don't think that if you don't buy now, you're not going to, right? This is not financial advice, but if you don't buy now, it's just not going to happen. You need for this thing to reset. Allow for the reset. And when it resets, whether that's 6 months from now, whether that's tomorrow, whether that's 2 years from now, it's going to happen. You have to understand these are the way the cycles play out. And if you can be patient enough to wait for the cycle to play out, you'll get a heavy, deep discount if you can wait. So, with that being said, we also had NVIDIA earnings, and they absolutely just blew it out of proportion. And something I said, if you don't follow me on my Twitter, I do morning updates there all the time. So I do provide daily updates there. There, I was talking about Thursday morning after NVIDIA earnings. I said you need to watch the price action on NVIDIA the next day. They blew it out of proportion. They jumped, essentially, they gapped up overnight, and then they just completely sold off. And then Jackson Hole started. I said, if that will tell you what the market sentiment is, not how well they did. We know they're doing well. And this is something I'm talking about in the gold rush. The people that essentially sold picks and axes actually made more money than people actually making that were actually digging for gold. And that we're in the same exact atmosphere, but your gold is AI and NVIDIA is your pick and your axe. So you get all this hype around all these companies developing the AI, but it's going to be the pick and axe that's going to make the most money there, NVIDIA. And so people are massively trying to gather up chips. We also found out that Snow has been essentially bulk ordering chips because there's potentially a big concern about chips shortage again here shortly. So this is something you got to pay attention to. So if that's the case, NVIDIA can pretty much charge whatever they want for their chips, as Elon Musk has even mentioned it twice in the last earnings call, that he kept praising the CEO of NVIDIA and how he wants those chips. And they're building out. There's just a new article that came out as well. Shout out to Ray Savage, but he essentially sharing that they're building out the whole infrastructure for AI. So that's their next big thing. And if you put Elon in anything, he's going to blow it. He's going to make it 20 times better than essentially any other buddy out there, any other competitor out there. But with that being said, you have to keep essentially an eye on that, and chip makers are going to absolutely crush it, especially NVIDIA. As of right now, they got a leg up on it. So that's really going to help the AI piece of it. Yes, they'll benefit from it, but a lot of the people's expectations are far exceeding that of what they currently are. There's a long way to go to where people are actually expecting it to be 5-10 years down the road. It's going to be absolutely amazing. And it also could be very scary in the same sense because of the fact that, just if it's not regulated correctly, it could do a lot of damage to humanity in general. So, and this is why Elon Musk has mentioned this multiple times. And so you have to keep this in mind that the way media manipulates you, imagine that from an AI. And AI can manipulate you the same way, especially with deep fakes and everything that's currently going on. AI could be very detrimental. So you have to put a lot of governance over what is currently being developed. Anyway, so that's that. NVIDIA actually crushed it this week. And again, they're pulling back. So that's your sign that the market is ready to start selling off. We waited for NVIDIA. They did well, but they've already ran up so much. People were putting upgrades up to $1,000 and maybe eventually, but also it needs to correct. And so from this point, all our major earnings are pretty much done. And rolling into Jackson Hole on Thursday, you got a lot of information, a lot of hawkish sentiment. There's some doves. You got your hawks and your doves in the Jackson Hole summit this week. And then Powell essentially reiterated a lot of stuff he's already reiterated. But, one of the biggest takeaways is inflation is jumping higher than anticipated, which in sense and can be deciphered as you're going to get more rate hikes. We've already said we'd be done at 5, and we're already halfway to 6. And there's already pricing in a potentially another rate hike in November. This is what's concerning. So they're essentially pausing, rate hiking. Essentially, they're pumping the brakes just in case, because when that lag effect does start to catch up, what's going to happen is it's going to be an overshoot, and then they're going to have to cut. So they want to try to pump the brakes so they can kind of feel it out as they go. And so this is why they're doing essentially a stop, increase, stop, increase potentially is what they're doing. So they're prepared for raising further if needed. They're essentially locked in that 2%. They want it down to 2%. We are still very far from 2% with where housing is and where food is. Food is still absolutely crazy, because food is also not just a necessity, but it also provides an entertainment value as well, and it's the cheapest form of entertainment. So people are eating. And that's what it's essentially calling. With all the stress that's currently going on, people would much more likely spend that money on food for entertainment value. So you have to understand that as well. So that's causing a complete massive inflation in food. And whether you want to try to ignore it or not, you need food to live. And so inflation, you maybe your used cars may be down by 20%, but it doesn't, that's just 20% increase in your food. So really, what does it matter when your food bill is increased by $200 every week, right? It adds up very quickly, and it's more than a car payment. And so with that being said, it looks like there could be a pause. We'll see what happens. Again, the numbers on we needed Jackson Hole essentially to occur to kind of gauge what that next essentially monetary policy could be. So we're going to have to see how that does play out. As of right now, we're looking for another pause, and then maybe in November. But we'll see. That can again change very much just depending on what happens. So remember, we were supposed to do 3 rate cuts by the end of the year. Now they're saying potentially another increase in rate cuts. So just be mindful of that. Again, I think what they're saying, what actually happens, I think we will get some form of event. And this is what I'm talking about. I'm not trying to predict exactly what it is, but we go off of probabilities. And that's what I try to talk about, is probabilities. And the probability of us getting a major event, I think, is going to happen sometime before the election time. I think it will happen. I think there's too much stress on the system right now. Maybe I could be wrong. Maybe we could push it out. I think ideally they would probably want to push it out till after the election, so that way whoever does get elected, it's their fault. It just really depends. And I think it really depends on because no one wants to take ownership of that. And so if they can, whether, again, not political, if it's Republican or Democrat, nobody wants to take responsibility of a collapse. So if they can draw it out if it's, the Republicans that win or the Democrats, whatever it is, they would take ownership of that crash. And so on the next election is how I would think they would try to play it out. But the problem is they are unsure if it can sustain itself till then. So this is why you don't get direct information from the Fed, because they are unsure. But when it breaks, they have to be prepared to react, is what they were essentially trying to gather out of Jackson Hole. And so they try to be, and Powell is very good at this, and talking in very general statements, and try not to give too much detail, because people will hang on his words and the market will try to correct off his words. So he tries to be, it's all data dependent on PCE, which PCE, I don't know how. A lot of these different things, we've talked about this multiple times, is that they're so pencil whipped. You can't really tell what the truth is about anything. They'll put numbers out and then they'll do something completely against what the numbers are saying. And so if things are so great, why are they continuing to increase rates? Because again, they're pencil whipping, and so they knew what's actually going on compared to what essentially the statements they put out to the public, because they're quote unquote transparent, but they will revise it months later to make it look like, oh, well, we made a mistake. Well, we see them make a mistake when they misplace a decimal point and give an extra couple billion to Ukraine. So being said, this is why I have this channel, to try to point these things out. Again, none of this isn't stuff I'm just making up. This is stuff that is coming out. You can see all the data that's out there, see the revisions, and then pay attention to the things I tell you to pay attention to. And you can come to this new storyline that's actually the truth, and depict this utopic view that's being portrayed, and then kind of understand what the truth is. And then again, it won't have an impact. What you're looking for is the impact on the market, and that won't happen unless this realistic view viewpoint that's currently going on, if that story actually hits the utopic view, that's when it has impact on the market. And you can even look back, even like during the pandemic, right? Like we were aware of the virus in China, right? And then ultimately understand that nobody thought it would be real until it actually had an impact on us. And so you're, as long as you're aware of it and what could happen, then you start taking more, uh, you start managing your risk a lot better when you know that that could be a strong possibility that it could happen. And then when it happened, you're not blindsided by just looking at a chart and thinking, oh, well, we're just selling off, I'll just buy at the next zone. No, because the event that's happening, let it play out, or have minimal risk on hand when that is playing out or playing to that point. And this is why I've been cautious a lot over the last couple months, because even though we've run up, I've taken advantage of some of the pushes up and some of the pushes down. But ultimately understand is that there is a bigger move coming. You have to be very careful of risk. Not every day in the market, not every year in the market is let's full on risk and it doesn't matter because the market just goes up. Unless you're a long-term investor and just want to throw it in there and don't care, I wouldn't advise against that, because you should at least be mindful of what the company is that you're invested in to make sure they don't go bankrupt or anything like that. But nonetheless, this is how you have to portray the market and understand that it changes. It's not the same every year. There's rhyme and reason that matches. But again, we are very, very close to 2008 in a lot of ways that this is playing out. And there is no difference in understand 40% of the money supply will be a bigger move. And so being said, again, I've pointed out all the strategic moves that have been taking place, whether that's through earnings, the way the banking crisis has been handled. These are all strategic to try to stop panic. And so it doesn't mean it doesn't stop what's actually going on. The events are still occurring. You are just not hearing about them because, again, they'll leak out. Oh, advanced talks that this bank is being acquired, or we just lost another bank. Oh, it's no big deal. Wipe it under the rug. We got this other thing over here, NVIDIA chips. They're doing fantastic. Let's upgrade it 5 times, and everybody run to NVIDIA, right? So these are the kinds of things you have to pay attention to, but understand that the underlying story is still true. And so let's see. So this week's events, we got core PCE again. The Fed want to highlight this. You have to understand that any data, again, is going to have more weight, especially PCE and non-farms. Again, both there's so many revisions that it really doesn't matter what's put out there unless for some reason it manages to make its way in. They can't pencil whip it anymore. Then it actually shows. Then it could potentially crash the market. Again, baseline, get you at a baseline. We are currently at a period in the season in which the market normally sells off anyway. So just be mindful of that. And so PCE will be extremely important to see what happens there, but more so is non-farms or more people getting laid off. We'll see what happens. We've had some big layoffs. We'll see how much of impact that has, especially with, yellow freight. They just let go of 30,000 jobs. Are we going to see 30,000 job loss in the report? Probably not. It may increase by 500,000. Who knows, right? This is how absurd these numbers are. They're coming out. They're getting so pencil whipped. And then it all depends on how they define it, because they like to change the definition. It's like changing the formula. Like you had a formula, then it messed up. You're like, oh, well, that's not the right formula. Let's go ahead and change it to this, right? So these numbers are so pencil whipped. It's absolutely absurd. So upcoming events. Now that Jackson Hole's over, we know that they're going to continue to raise rates. Again, what we are looking for and what I emphasize is we are looking for an event. You will know what happened because that one event will produce such shockwaves in the market that everybody will hear about it. That's what we're waiting for. We know that the pressure is on. You're just waiting. And this is the thing that you can't gauge. So I try to define everything that, yes, this is going to happen. I'm not just one of those people, it's going to happen, it's going to happen, it's going to happen. Yes, it will happen eventually, but you have to know what you're looking for. There will be an event that would be a break from interest rates, whether that's more massive layoffs. You're looking for the event the one event where you're looking for is the event that's going to cause the Fed to start cutting, because that is the event that's going to crash essentially the market. That's when the market just says, oh, we're in a recession, and then the market just starts selling off. So we're looking for the event to get ahead, because they're telling you that, oh, the recession isn't going to start to the end of next year. So that means sometime between now and the end of next year, you're going to have a crash. We don't know what that event is, but that event is going to happen. It's going to force the hand of the Fed to have to cut. That is what we are looking for. And so when that event happens, then you are ready and you're prepared for the next move. You know what the next move is. Is it that they will price in a recession? And that's when you just start buying and buying and buying until whenever the case is. And ultimately understand, again, the market will recover a lot faster than the economy will. This is going to absolutely just destroy the economy for the next couple of years, especially now that we got downgraded on our credit, got downgraded on more banks. And that was the other thing that came out this week too, is BRICS. They've essentially just aren't going to trade into the dollar anymore. And that's where essentially our powers come from ever since we've been off the gold standard, is that we've essentially held power because of the petrodollar. And that's essentially what's been giving us so much strength. And now that we can't, or they are removing the weaponization of the dollar, that puts us in a bad spot. And that's what they're trying to do, because the U.S. has gone complacent, not just over this presidency, but over the years, over the past couple decades. We've just been complacent about everything, and now it's starting to show. And those cracks are showing, and those cracks are widening from all the years of just of not doing what we should be doing to better the economy, and not just trying to get some essential kickback money is what we're looking for there. So nonetheless, next monetary policy is on the 20th of September. So we are looking for that. That's going to be a big one. I think they're going to, again, pause. I think we're more so waiting for that increase to be in November. Again, an event can happen anytime between now and then and change everything. It can just change all these numbers very quickly. Core inflation, the next big one, is on the 13th. So we're going to get the G20, and then we're going to get core inflation right after. As far as earnings, there's some good earnings. CloudStrike is out there and stuff, but at this point, I'm just waiting for the next earnings cycle, which is in about a month. So we got one more month before we start hitting the big. And this is what I'm talking about. These earnings cycles, they come back fast around. So in about another month, we'll start. Probably another week or so, we might start getting in earnings mode. And some of these ones that have been selling off, now might be the time to start buying Tesla and everything going into the next earnings cycle. But be aware that you have to be very careful with your risk, because what could happen is something could occur and we could start selling off. And then that could force the hand of the Fed. That's the one, like I said, I just want you to keep that in back of your mind. That's the one thing you got to watch. If there's an event that happens and the Fed start announcing cuts, you need to be prepared, right? You'll kind of get that forewarning. It may be a day, maybe an emergency cut because some event happens, but when it happens, you have to be ready, is all I'm saying. And so this is why you have to be mindful of the current events, so you know what's going on. But anyway, so this week, a lot of these numbers are dwindled back to normal. SPX is still a little inflated there. There might be some over digestion of what's currently going on with Jackson Hole, and so that might have some sort of effect. But ultimately, the numbers, this is why, because of what's going on with non-farms and core PCE, the general index is still a little high. It is down from last week because Jackson Hole was a big event, and so was NVIDIA, but now we're kind of back to normal. So with all that being said, I know that was a huge rant. I try to get out a lot of information, a lot of things I think about, and this is why I have this channel, is to document all of my thoughts and ideas and where we're currently at and where we're currently going, and then kind of go from there. So with that being said, when it comes to the index, again, we started to sell off right when we got the credit downgrade. We've got a lot of bad information since then, a lot of China bad information as well. Bank downgrades, more banking crisis. And here we're still sitting roughly, we bounced roughly here, which is a weekly support. This is the first 20 weekly support. So we've been very overextended. This is our first time we've actually hit the weekly 20 EMA, and we got a bit of a bounce. The question is we need, if the bulls want this thing to continue, we have to hold a 43.48. If we dive below 43.48, we are going to 4,200. That puts us right back here, and kind of what you want before going into the next earnings cycle is at least trying to retest that 4,200. That would retest the breakout that we've had over this long period of time here. And so you want it to at least come down here for a bull market and then potentially start ripping back up. That is a pretty big drop already. So we'll kind of see what happens there. But ultimately understand that ideally, if we could get a break and a retest, that'd be great. And then potentially run up. If you want a bull, bears, again, you're going to want this thing to not only break that, but come down to the 4,200 and break that back down if you want a new low. And this is why I say this, because given when the Fed cut rates, it's going to be a very, very historic event that's going to do it. You have to keep in mind, how did we get to 3%? We got to 3% rates because of the pandemic, and the lockdowns caused a crash. And again, I'm not trying to cause panic, but they are talking about a new virus, and potentially boosters just came out a couple hours ago. Is it a potential to be locked down again? That could draw a lot of panic if it happens again, but it could kill the demand that is in the market, considering what is going on. It could be a very strong possibility. And if that's the case, it could be in some big trouble, especially when you start talking about commercial loans and the amount of commercial loans that a lot of regional banks hold. Man, that would be absolutely devastating. That would destroy probably more than half of the banks if at this fragile point, we are in a very fragile point. If they locked us down, it would absolutely kill commercial real estate and would absolutely obliterate and kill demand, and we would just drop. Be mindful of that. And so that's why I'm saying that could potentially give us a very strong new low. That would be a great reset, like the Great Depression, like 2008. It's a very strong possibility, and you have to understand what is at risk. It's good because it provides normalization. We need normalization in the housing industry. We need normalization, all these other things. But what you have to pay attention to is that not only that, people will be in a bad state. So if you can survive up to that point, things will be at a very deep discount. You just have to survive to that point. So again, we'll see what happens there, but that's what we're looking at there. Bitcoin's the same thing. It's finally breaking down. It does need to break here, that 25K mark, which I think it will. I think we'll also see new lows on this. When that panic comes, it's going to hit everything. And I think the one thing you need to be paying attention to when it comes to crypto is Binance. I think Binance is the card that's going to help drop crypto. I think Binance will be exposed. Whatever the case is, I think there's some news going to drop, and then Binance is going to be exposed. And then at that point, it's going to drop crypto. It's another on-ramp that's destroyed, which essentially would send it to new lows, in my opinion. Again, I don't know if that's going to happen. It may not happen. I'm not trying to fear monger here, but I have a strong feeling that they don't want people, the markets in general, don't want money flooded into crypto. The Fed does not want money essentially flooded into crypto. So they will do whatever they have to do. And if you haven't seen or watched my channel to this point, you will see that they do. If you're in the markets long enough, they will manipulate stuff to get the agenda that they need done. And it's not a conspiracy theory, because it happens all the time if you're paying attention to the right things. And Bitcoin is one of them. And I think it will have a very strong reset. How long will it drop? How low will it drop? How long will it be there? I don't know. That could be prolonged. It really depends on once these rates, once that event happens where they're having to cut rates, how bad is that going to be? It could be really, really bad, and to the point to where it absolutely obliterates everything. Because that's what I'm saying. Like, you get into that second phase where it's okay. Now we got the rate cuts, but now you want demand to come back. And how do you stimulate demand back when you've absolutely just obliterated everybody? And that's kind of what you're talking about when the adjustment from phase two to phase one to phase two is that waiting period. And then phase three would be essentially quantitative easing and getting that demand back, and the demand is back, and that's when the market starts to rip. But it's that between phase 1 and phase 2 on when will that demand come back to hit phase 3 where it starts pushing back up, because you just absolutely wiped everybody's savings, you wiped their homes, you wiped everything out, they have no job. That is the problem. That's where Powell is trying to get. And so to be able to get there, it's going to have to be bad, because you printed 40% of the money supply. So you got to siphon all that back out of the system, and then try to adjust it and hopefully get that back in, whether that's issuing checks here. They've been talking about doing that again. So you see this pattern play over and over and over is what I'm saying. And we are pattern recognition creatures. And so when you see these patterns, you call them out. It's not like I'm just blindly stating these things. These are the things you can go and look and see that they are all occurring, and that they are talking about stimulus checks again for child dependence and stuff like that. So if that's the case, if we go on lockdown, could crash the market, then they start issuing out checks again and then re-stimulating back into election. It's funny how that would kind of work out, but it does. It's a good, solid educational guess, right? Probability of that happening, I think, is very strong compared to some other cases out there that would just continue to rip, because you don't want it to continue to rip, because then we go into hyperinflation and that causes way worse problems than you can even imagine. So with that being said, we'll see what happens. But sorry for all the ranting, but there's just a lot on my mind today. And then as far as Tesla is concerned, again, it started to pop back up with the AI stuff. We have to see if it will pop back over the 241. Otherwise, I think this is actually going to get rejected. It does need to break back down below the 200 if you want this thing lower. If it does break that 200, though, we can get a big jump. And I just talk like the SPX is the same way. If we can get that break, there's a big drop on the other side of that break, but we have to see if we can get that break. Will we get enough bad news to be able to have that occur now? The market is already starting to push back up, so we'll have to see. Palantir still waiting for a break here at the 1371. See if that can happen. There is a 200 daily moving average roughly around here, around the $12. So expect a bounce there. I might get my first buy there, but if it does break there, then you're looking at 10, and then you're looking at 7 there. So that's what I'm watching there. BA, again, this is what I'm talking about. This is what I'm waiting for the market to do, is the break, the retest. You will see if this retest holds. This retest comes back down and breaks back down in this range. That is a problem. This is a liquidation. This is what I've talked about, is I'm looking for in the general market. This is a liquidation spike, is what all this right here, because the banks, they know off of here, people have essentially stops and everything else placed in here for people that are holding puts. Same for the call side or shares, or whatever the case is, if you're shorting or going long. They're well aware, that institutions are well aware that if I want liquidation to be able to move the market one way or another, I can let it build up so people can build essentially their stop loss. They don't get tagged out to either side of this. And then when it breaks up, you get liquidation. Well, I want to go down. So to be able to do that, I got to break out like I'm breaking out, get all my liquidation, and I can have a huge move down. So that's what we're really watching for, to see if this is actually a true bull push, or is a liquidation up here, and that this thing drops down and breaks these levels. So we're really watching to see if we can break this 216 and then break down over this 191 as well. So those are things you got to watch for, and what are the moves that occur over and over and over. The same with JPM. We want to see if it can hold the 142. If not, if it breaks that, I can expect it to be down to 124, and then see if we can hold that. If not, we got a lot of gap fills here we still need to fix, so we'll see if that does happen. So this is a very long video, so I do appreciate you if you made it this far. If you have, go ahead and drop a thumbs up. Till next time, I'll see you guys later.